Kim, are you ready on your side?
I am as ready as we're going to be. Thanks, Earl.
Okay.
Thanks for the intro. Thank you for everybody that has dialed in. We might get some more joiners. I'm going to get into it as quickly as possible because we do have a fair amount to cover today. In addition, also just to share from our point of view, myself and Alvin, we are pretty much also decentralized and with the whole purpose, as Earl explained, to be able to assist in global or whatever the case might be, and I suppose in situations where we find ourselves now. So I'm sure most of us are indeed dialing in from home or some kind of isolated spot. And unlike when Alvin and I were sitting together a couple of weeks ago, we are now sitting apart in two different cities. So if you do have any questions, Alvin will be fielding them just like he was a couple of weeks ago. But we found a way that he will communicate with me throughout. So if it is a little bit more haphazard, we do apologize. Definitely not our intention to change it up. But safety-wise, I think that's pretty much where everybody's at. So I'm not about to discuss the conspiracy theories of COVID-19 and what it means. I'm going to get into IFRS 16, which is probably where I feel a little bit more comfy. Alvin, are you ready? You want to say hi? Just pop in there.
100%. Good afternoon, everybody. Enjoy the session. Please throw the questions out. Like Kim said, I'll communicate to her. Otherwise, I'll answer them individually. And Kim, off to you.
Rock and roll. Thank you, Al. Please also note that if your questions are of a more personal, in terms of it's your facts and circumstances based, please do feel free to still pop them through. We might just answer you in the sense of, well, this is one that we perhaps need to take offline. IFRS 16 and the permutations, the different, just the different types and terms and conditions included in the different contracts. There's just no way we can address all of that. We're going to have a look at what our focus is and what our focus is not in a second. But please don't feel like we won't help you. It's just a question of what's appropriate in a webinar like this. So moving swiftly, you've got our details if you need to contact us with any information relating to a query you may have. IFRS 16, we are seeing lots of issues in this regard. You may note that a lot of what I addressed in the two previous sessions was also in light of going live with a new standard. So a lot of the lessons learned, hopefully we can fix, address, and deal with going forward. So this guy went live essentially on 1 January 2019. So if you had a December year end, you would already have applied this at 31 December 2019. Any of the February year ends now for 2020 and March coming up in a week and a bit's time, this will be the first time that we're going live. So perhaps we're a little bit after the fact, but we're also still hopeful that there is enough time to find compliance very quickly. So what won't we be looking at today? And I did this purely because there is a lot. I could speak for, similar to IFRS 15 and 9 likely, I could speak for about 5 to 7 days on what it contains, addressing all the different nuances and trickies. Today we won't be dealing with lessor accounting, and that's purely because it has essentially stayed the same. So the dual model accounting principle of differentiating between a finance lease and an operating lease is still the same. Those characteristics that we saw on how to distinguish between those two types of leases have literally been regurgitated, brought forward into IFRS 16 from IAS 17. We also won't be addressing sale and leaseback, and for a variety of different reasons, the major one being that it's not that prolific, but there is a fair amount of rocket science to it, unfortunately. So if you have one of these or you're unsure whether you have perhaps entered into something of the like, it is definitely worthwhile to figure it out sooner rather than later. The accounting hinges on whether it is or is not a sale in terms of IFRS 15. And a sale in IFRS 15 is all around the transfer of control. So previously, we really didn't, we couldn't care less about that. We looked at it purely from a perspective of are we selling it and then leasing it back from this buyer, and then we would just apply the finance versus operating. Well, now it's quite different, especially obviously from the point of view that we're dealing with lessee accounting has changed. So if you've sold it and you're now, in terms of IFRS 17, just using those wordings, if you're now leasing it back, well, we've got to make sure that the initial transaction where we entered into with the financing house, I'm going to call it a bank. So if we have sold it to a bank, has that sale occurred in the confines of IFRS 15? And the control issue we'll find most commonly, I mean, Alvin and I have dealt with a couple, the answer is no, that you are not transferring control. Now remember, control has a few factors that will indicate control, and we really need to apply some judgment there. But for the most part, what we're getting is financing. So if we don't meet the control, i.e. the sale criteria under 15, all we have is essentially a financial liability with that asset as collateral, which is, in my opinion, obviously what it's always been, but we had a very different model, obviously, from the 80s. So financial liability that'll be in the confines of IFRS 9, and that changes a couple of things. I had an entity recently who liked to combine their finance cost relating to the lease back, as well as the finance income that they were getting from the lease that they were entering into with customers. So it really does create a bit of a rewrite of accounting policies, and likely also just the understanding of what's actually happening in your profit or loss. Thirdly, we won't be dealing with subleases, and subleases often very tied in with sale and leasebacks, sometimes not. But I do need to apologize off the cuff. I saw it a little while ago and I thought, oh, you know what, I'm just going to leave it in there. I know that not everyone loves abbreviations, especially from the likes of us techies who come up with funky things, but an IL is really just referring to an intermediate lessor. So in other words, in your initial head lease, you will be the lessee, so you are leasing an item from somebody else, and then when you enter into the sublease, you become a lessor. But you are obviously not the head lessor, you are the intermediate lessor. So that's what IL stands for. And really we look at these two things are completely two separate contracts. It is highly unlikely that either party, the head lessee or your lessor, actually knows about each other or knows that you've entered into this kind of contract, and quite frankly also couldn't care less. So there's some nuances around subleases, disclosure specific issues, and obviously making sure that your accounting policy addresses such. We have a few where entities lease premises as the head lessee, and they then subsequently sublet to other lessors. These are imperative in getting your accounting policies and the disclosure right, but not prevalent to everybody, so, and definitely not the focus of transitioning. And then lastly, just on investment property, a lot of entities, if you are leasing and it meets the definition of investment property, it must have the same accounting policy applied to all investment property, i.e. owned and leased. So most commonly we see the fair value model applied. This has to be applied then to your leased investment property as well. Not particularly difficult, but again, not prevalent to everybody. What we are looking at today is my main focus, and I'm going to keep this in mind as we go along timing-wise, is on transition. I want to take you through an example, mostly because there are three, and they're really only two transition approaches, but one of them is broken up into an either or. So I'm addressing them from a three transition approach, approaches available. And I want to explain the impact on the numbers, because not many entities are understanding why or how they should choose something. There's definitely cost benefit in all of these approaches, and that can sometimes override your care for what's going to happen in the numbers. But I think to know what happens in the numbers as well as what do I need is imperative. Working back up, we are going to look at the recognition exemptions available to us. This, ladies and gents, comes in the form of a short-term lease, and then what the standard is calling a low-value item or low-value asset lease. The disclosure on these two is also very particular, both in the profit or loss as well as in your cash flow statement. We need to show those cash flows and the expense, whatever they might be, for each of those separately. In addition, you won't be too concerned with the fact that these are still going to be straight lined. So straight lining is not dead. It's just in isolated circumstances where you do apply the recognition exemption. And I'm going to jump straight in with it. I hope I don't get slaughtered for this. These recognition exemption leases are essentially the old operating leases theory. That's what we're going to apply when we select or elect to comply with recognition exemptions. So you still have to use the concept of straight lining. It hasn't left us. The next one, and I really don't want to spend a lot of time on it because it can get very tricky, identifying a lease. I want to point out the issues, and hopefully you're able to then go forth and conquer. The more complex ones are going to stem from those entities where they previously applied the interpretation IFRS 4. So if you've never dealt with it, maybe it was never an issue for you. In some instances, for instance, we all know about the internet issue a couple of weeks ago. So it was the CCOM cable, the under the sea communications cable, that was broken, faulty, had an issue. Now, when communication entities lease their portion or their capacity portion of those CCOM cables, previously we used IFRS 4 to determine whether there was or was not a lease. If you fell into IFRS 4 and we then concluded, yes, there was a lease, you then applied IAS 17. With doing away with IAS 17, they've also done away with IFRS 4. So IFRS 4 has now been incorporated into IFRS 16, and that's where we take a moment to check, do we have a lease? I'll go through those criteria. Shouldn't be too difficult, and I'm not, however, going to be spending a lot of time on that. If you're worried, take that one offline with us. We can address later. And then we have separating the components of a lease. Now, this is important for everybody, I believe. I don't think there is a contract that I've seen where, for instance, if you're renting premises, where there isn't cleaning or insurance or some kind of cost breakdown. Now remember, you're getting the right of use for the premises. Any costs over and above that are essentially non-lease components. We'll see now, though, that the standard provides us with an opportunity to go a practical route and say, well, I'm not splitting this stuff out. This is not my jaw. I'm not interested. Combine all of those costs, call them the lease component, part of the lease, the lease components, and as a result, all payments are then considered lease payments. What's important to note there, though, is that that increases your lease payments, and as a result, the lease liability. So depending on what those costs are, you could end up capitalizing a rather large lease liability. Concerning? Well, maybe. And if you don't want to, don't worry about it. You're then obviously going to take the purer approach and exclude any what we call the non-lease components. So again, I'm not going to go into detail. There is a slide. I will refer you to it, and it really is up to you. Your standards and interpretations not yet effective note, well, in this case now, newly effective note, will need to address which of the practical expedients you have applied. Going forward, your accounting policy will also incorporate these. So please do make note now, if you don't mind, that you need to keep track of any practical experience you select, notify now in the change in accounting policy note, or as I said, the one where we talk about our newly effective standards, as well as keeping track for accounting policy building going forward. And then last but not least, we'll go into the transition requirements. What relief do we have there? Again, there are quite a few practical expedients we can apply in going from old to new. Why do we care? Why, people always say to me, Kim, why do we constantly rewrite these things? Well, yes, perhaps. Alvin has just let me know around the low value item lease. We'll talk more in detail about these now, but I can address for you so long. The short-term lease is less than 12 months, but without a purchase option. So if it is 6 months, but it has a purchase option to it, you can't apply that recognition exemption. And then we have a look at our low value item. And the low value item, even if you won't be able to see it in paragraphs 5 and 6, it doesn't give us the amount or the value there, but it is spoken about in Appendix B, where it is the equivalent of $5,000 US or less. So for us, that'll be a moving target throughout with the exchange rate. But a low value item lease, you can only apply that recognition exemption if it is $5,000 USD or less. Both of these leases, short-term and low-value item, are straight-lined over their relevant period. So you can appreciate that a low-value item lease might very well have, let's say, a 3-year period attached to it, in which case you will straight-line over the 3-year period. A short-term lease won't have a 3-year period, obviously, by its nature. But if it does straddle 2 periods, it makes sense to obviously then straight line it over that period. I hope that addresses that issue. Let me know if there's anything else, and I'll address it when we get to the slide. Why the new lease standard? As I was saying, people always say, why do we keep rewriting things? Yes, fair enough, keeps me in a job. But at the same time, it is also necessary to move with the times. Now, this is one of those standards that finally has got something right. In other words, when we signed an operating lease contract, we were binding ourselves to make payments for a specific period of time. Now, if that's not a liability, I don't know what is. Okay, so we had an obligation to make future payments that would result in outflows. Sorry, it just comes straight back to the contractual framework. And that's how we are where we are now. So understanding why the need arose and that the driver of this entire rewrite was the lease liability, in other words, the obligation that was missing. For an obligation, we obviously needed a corresponding debit, and we all know that a debit can only ever be an asset or an expense, or for some other reason, a reduction in equity, the residual value. So they looked at what we were getting here, and we'll get more into it, but you're going to see that we're dealing with a very basic, a right of use asset and a lease liability. And the value of the liability is what will drive the value of this asset that you're getting. Because remember, by saying, look, I'm obligated to make payments, you're saying, well, what am I getting for these payments? And I'm getting the right to use something for a specific period. Leases, ladies and gents, are an important and very flexible source of financing, and I think we'll see more of this going forward now in the next couple of months or perhaps years. But the estimate was that listed companies have approximately $3.3 trillion in lease commitments. And the scary part is that over 85% of those were considered operating leases. In other words, they did not appear in the balance sheet. Now, if you are contracted to make payments, you can appreciate 85% of 3.3 trillion when we're looking at listed entities. Well, that's a big debt number, and debt that is not in the financials. So financial analysts and investors, it's very difficult to get a clear picture then. And also from a comparison point of view, people always say to me, but Kim, we're required to provide the disclosure for operating leases. Yeah, and we all know how well we comply with such requirements. We would literally put in the bare basics of our commitments. And yeah, did it really matter? No, it didn't speak to the balance sheet. And, that was our main issue. It really was a sad state of affairs. So very difficult for investors to assess, and often they would then overestimate to compensate for the lack of disclosure and obviously this financing approach. So what have we got now in IFRS 16? As I've mentioned, we won't be talking about the lessor model. It's same, no major issues there. I have already also mentioned that we went live with the standard approximately 15 months ago. If you early adopted, so any entities, if you are interested in going back a couple of years, there were a few that decided to do it at the same time as IFRS 15 and 9. But obviously, the thing is that they couldn't go early with 16 a couple of years back without doing early 15. So a lot of them did all three at the same time. That was just the big bang. But if you ever did 16, you had to do 15 at the same time. So that's all that's about. The practical expedience, we'll get into, we've mentioned some of them, we'll get into more deets on that. But let's just take a look at this single lease accounting model. As I've already said, you are going to be recognizing a right of use asset, and that is as a result of your lease liability. Very important that you understand that A's number, in other words, the lease liability, drives the right of uses number. There is no classification test. So unless you meet the recognition exemption to comply or utilize these two, i.e. a short-term or a low-value item lease, you are bringing it on balance sheet. Done. So it is far-reaching. It is rather complicated for some entities because it has always been such an attractive source of financing. So we're going to recognize the asset and the liability pretty much like we always did with the finance lease. So finance lease accounting is now prevalent throughout. And ladies and gents, this right of use asset will be depreciated, follows the same concept as IAS 16 on property, plant, and equipment. And our lease liability will have its finance costs recognized over the period using the effective interest rate. I think from that you can already see that there isn't a primary statement that's not affected. So your balance sheet, your income statement is going to change quite radically. And then we're also going to see a change in the statement of cash flows as a result of this. We want to see your expense, your interest expense, your finance cost shown very, very specifically. Again, you still have the option of putting it under operating or financing, depending on what your policy is. But let's face it, this more than anything will walk and talk like financing. So whatever your choice is in terms of accounting policy, you've got to make that clear in the accounting policy for leases as well. Okay. We're going to have to address that question. Al's just popped me through a question asking me around deposits. I'm not quite sure what is meant by that. Let's have a look at that if you don't mind during the break. Maybe if you can get the delegate to provide some more info, we'll address from there. Okie dokes. The other another practical expedient worth mentioning here is a portfolio level accounting. Now, some entities have got lots. If you think of retail, for instance, they've got lots of operating leases around premises. And there's some relief just to say, listen, you don't have to go and look at these things on an individual basis. If they walk and talk similarly, they have similar characteristics, and the answer wouldn't be materially different if you did them together or alone, separately. So that will mean that you need to run some simulation at the beginning to make sure your answer doesn't materially differ between portfolio and individual accounting. But once that's done, it'll make sense then to combine. That just means that you've got a similar lessor, or it might be a similar area. It might be a similar borrowing rate, the interest rate that's prevalent. Not many entities applying that. It's not too far-reaching in my experience that I've seen, but there are more practical experience to come, so keep your notebook ready to highlight what you want. On the recognition exemptions, we see the two, as I've mentioned before, and give me a sec. There we go. And where I said before, we need to straight line these over the lease term. One is called for short-term leases, and the other is low-value items. 12 months or less without a purchase option, underlying asset has a low value, i.e. less than 5,000 USD. The choice for short-term lease, applying the recognition exemption for short-term leases, is going to be by class of underlying asset. So again, not something that I commonly come across where people enter into a lot of them. So if you've just got a specific class where you know you only lease it for 12 months or less, that whole class would then have short-term applicable to it if you have a 12-month or less as a lease period. For low-value items, however, different. You can choose on a lease-by-lease basis. So here the example is, and I've used a computer, if you lease your laptops, let's say for 3 years, one of the laptops comes in, you can choose to apply the low-value item, or you can choose to capitalize. Okay, so just important there that you do have those choices, but it's got to be made clear ultimately what you've done. And we'd like to see that in the financials as well. Moving into the identification of a lease, this slide pretty much deals with the key elements. So lease definition, the wording is just updated. It's updated to 2000 wording, call it what you want. It's just more modern wording. I just want to do a side note. Obviously, I think we're all pretty aware that most of us are working from home. I definitely am. And there are a couple of little kids around the complex, etc. And I'm sure we all have a bit of sympathy that they're also climbing the wall. So if you do hear any noise, I do apologize. I read a meme yesterday that said we should now refer to everybody in the household as your co-workers. So there's some funny things coming through with your co-workers when they are kids and pets, I suppose. So please do forgive if there is any background noise. The lease definition now says it's a contract that conveys the right to use an underlying asset, that's what UA stands for a period of time in exchange for consideration. It used to read slightly differently in terms of it used to be a series of payments or a payment, and just older wording. The key elements of the definition, there is a flow chart included in paragraph appendix B31, pretty cool. And it asks us, do you have an identified asset? Now, ladies and gents, an identified asset is for all intents and purposes very clear, except there are nuances where it can be a bit tricky. So I mentioned earlier the CCOM cable. If it is a capacity portion that you are leasing, it needs to be physically distinct. Okay. Otherwise, all you're getting is a service. So for instance, the CCOM cable, if we know that, if we're renting 10% of the CCOM cable, well, if we can physically ring fence our portion of those fiber optics, then great. But that's highly unlikely. So you can clearly see that the standard has moved towards it's got to have physical distinction. The other issue is around sometimes there are T's and C's, terms and conditions included, which will prevent a lessee from having certain decision-making opportunities. And in that case, we might see where there are reasons for a lessor to dictate how, what, when, where, why it can be used. And as such, if they can replace that identified asset at any point in time, and it's not going to cost them the earth, you don't have an identified asset. What do I mean by that? This could often be in fleet situations. So if I've got a lease whereby I am leasing, let's call it vehicles, and we have named and shamed the vehicles with number plates, etc. And I'm going, well, that's a physical asset for sure. Except if the lease says that the lessor can take back a vehicle at any point in time, as long as they supply you with something of a similar ilk, and replacing it will not cost them anything, or it'll cost them substantively an immaterial amount, then we don't have a lease, because at any point in time it can be exchanged for something of a similar ilk. We see this often with road rail, with road and rail. If it is replaceable, it might not be an identified asset. So careful on going, well, I can touch and feel this one, so it is. It might not be if it's easily interchangeable by the lessor. If we said no to that, we're immediately in, it doesn't contain a lease, and we're likely just in a service level agreement, i.e. you pay for what you get. The second question in deciding whether you have a lease or not is, does the lessee obtain the economic benefits? Now, here there are just some questions around it receiving all the benefits, some of the benefits. There's some questions perhaps around what happens if I need to pay commission to, let's say, a landlord, based on my sales or whatever the case might be. Sometimes there are trickies and people are trying to argue that I'm not getting all the benefits. Some people argue that I'm not getting the benefit, let's say, from using vehicles in South Africa, which is where my practice is. My business runs throughout South Africa. But I'm leasing, and these vehicles, in terms of this lease, are only giving me economic benefit in Gauteng. Well, clearly you're able to get all the economic benefit from using those vehicles in the prescribed territory. So that will not result in you not having a lease. And the third and final question is the lessee able to direct its use? So the questions there are around the how and for what purpose this item is going to be used. Is that predominantly in the hands of the lessee? Now, I've seen a couple of examples. If we think about really big mining equipment, the continuous mining, the mining machines, those cannot be operated by anybody. So often you'll see that there's a restriction in only a qualified engineer can operate it. That's not telling you, you can't operate it based on how you want to. It just means, please, can you have someone smart enough to drive it? Sometimes these machines are not allowed to be operated at night. Again, within the confines of protecting the asset or the lessor's item, it's not dictating how you can and can't use it. So we see things like protective rights, okay, and we should be quite comfortable with those. Ultimately, can you still generate benefit from it? Are you still allowed to make choices around where it mines on your property? Yeah, for sure. Okay, great. Then, we're in the confines of a lease. I think you can appreciate that the more sticky, the more complex, perhaps the nature of your business, whatever it might be, perhaps there's some questions that need answering here. But that'll only be able to be answered or at least questioned by yourselves, and on further investigation, we can perhaps assist you in answering that. At what point do we assess whether we do or don't have a lease? At inception. People often get this wrong. There is a difference between inception of a lease and commencement of a lease. Inception is the date that we all sign the dotted line. And it's at that point that you already need to understand what it means and dictates and details around lease accounting. The commencement of the lease is the date from which you are getting the right of use of the underlying asset. Okay, so really important that we get that right. I know that sometimes the tail wags the dog, but this is the requirement of the standard, and it's important for me that you understand that there is a difference between those two dates. We only reassess the lease, what it entails, whether it still is, still qualifies or doesn't, when the T's and C's change. So when the terms and conditions are rearranged, well, that might lead us to say, well, it is not a lease, or perhaps that just means that the numbers have changed, or the length, the lease term. So it's really important that we keep track of our changes in our leases and we evolve as they do. That's really the most important there. I've got a couple of slides. I'm not going to talk to them in detail. They really are for your benefit more than anything, in order to assist you in perhaps posing the question to us, not necessarily finding the answer. This here is around identifying a lease. I did mention a capacity portion can be identifiable if it is physically distinct. Even if the asset, however, is specified, I said already, a lessee does not control the use of an identified asset if the lessor can substitute it for another asset during the lease term. And that right, ladies and gents, needs to be substantive. And substantive means, just kind of obvious, that it can be exercised. Not that it will be, but that it makes kind of common sense. It's not a far-fetched situation. Substitution rights are substantive, as I've already just said now. Common sense, we've got to have the practical ability, and the lessor must be able to benefit economically. The substitution rights are also only considered for their substantive nature at our dear friend inception. So we exclude anything that's unlikely to happen from that assessment. Here's a very simple example. If we're leasing some space in a warehouse, we enter into a 3-year rental contract, and the owner provides us with 2 options. Option 1, to occupy a certain area of XY cubic meters. The specific space will be determined by the owner based on the usage and any availability. The alternative to that is that we will occupy unit number 13 of XY cubic meters in sector A of the warehouse, i.e. that is assigned to you and it cannot change for the duration of the contract. Perhaps a very simple example, but nonetheless, hopefully it drives the issue home that same space for all intents and purposes. And even at the inception of the lease, the warehouse owner might say to you, well, I intend to put you in unit number 13. It doesn't mean that he doesn't have the substantive right to move you out of unit 13 should someone else want unit 13. And perhaps you're not using all the space, and you get where I'm going. It can be a change at a later stage. Directing the right of use, as I mentioned, the how and for what purpose decisions. If, ladies and gents, these are made by the customer, i.e. the lessee, we have a lease. If they are made by the supplier, and in most cases, I've seen this only where it's a standard, terms and conditions, very clear that it's a service level agreement. But if the supplier dictates to you how, when, where, and why, we don't have a lease. And the difficult one is when it's arguable that how, what, where, when, and why is predetermined. So this one is not that clear. The questions that we pose there are, did you sit around the table with the supplier to discuss your needs? Would we find that your lease looks different to someone else's lease from the same lessor? So those are ideas that you can kind of go, well, I wouldn't really know, Kim. Well, okay. So if you just signed a standard generic item, we might need to look carefully at what it is that you have leased and whether you have the ability to direct its use. Because ultimately, on further analysis, we could end up in either of these 2 buckets. So perhaps straightforward in many situations, not so in all of them. It's important that we understand that when we look at these decision-making rights, that we look at those that are most relevant to changing how and for what purpose the asset is used. In other words, ladies and gents, it's got to affect the economic benefits that are derived. Relevant decision-making rights would be the type of asset, when it's used, and where the output is produced, whether it is produced or not, and what the quality of that is. Those that might not grant the right to change how the asset is used and how decisions are made is the right to operate and maintain it. Remember, how you operate something could be dictated to you purely from a protection point of view. And the maintenance might also be protection. So those rights included in the terms and conditions might very well be protective rights as discussed on this slide. It could be to protect the personnel of a lessor or compliance that's required by the lessor with certain laws or regulations. The scope of a lessee's right to use an asset is obviously going to be defined, but we want to make sure that when we look at each of the rights discussed, that in isolation, that these would not prevent the lessee from having the right to make decisions. And those, ladies and gents, will generally be your protective rights. They do have an influence on using the asset, but they don't ultimately tell you how or when to use it. Examples, the standard has helped us out with a couple, definitely not a laundry list, to specify the maximum amount of use or where or when it can be used. Think about those mining things that I just spoke about, not allowed to be used at night. Don't let an unqualified person drive it. Make sure it's stored in a certain spot at night. The operating practices or maintenance practices thereof. And then also to inform any supplier of changes in how it's going to be used. So we're going to move continuous miner number 5 from site A to site B. Because likely when you signed the contract, it said it could only be used on site A. I'm sure you get the gist. That's that, said the proverbial cat in the hat as far as identifying. Moving on to separating. This one here is a practical expedient, so working backwards from the bottom of the slide. It's an accounting policy. Make sure you elect, and ladies and gents, you may elect by class of underlying here. So, for instance, for your premises leases, you can choose to combine all the costs because, hey, it's small, it's, it makes it easier, whatever. For your other, maybe your equipment, that you lease, maybe it's more intricate. Maybe you don't actually want to split it out. What does that tell me? Well, it just gives me the opportunity to combine all lease and any associated non-lease components and call it all lease components. Move on, call it a day, make it easy for yourself. However, we have the choice to split them. So what would we do if we split them? If we don't choose the practical expedient, and please note I've split this between when we are the lessee and when we are the lessor, because it applies for both. If we're the lessee, we will separate and allocate based on standalone prices. Let me illustrate quickly. I've got a small example, drives home the issue. Assuming you chose option 2 earlier, where I mentioned that we're going to have the unit 13 of XY in section A, sector A of the warehouse. And we said that we've got a payment of, ladies and gents, CU just stands for currency units, okay? It makes the slides globally acceptable. This is a per year payment, so you can see I've kept it easy. Payment includes the rental as well as weekly cleaning. We need to split that 10,000 now into its lease element and the cleaning element. And the way we're going to do that, the standard says relative standalone selling prices. So we take a squiz around, a similar unit in another warehouse will cost us 9,000 per year. And if we wanted cleaning, we would have to pay separately 1,500. Ladies and gents, this is a fairly, I'll come back to my solution over there. It's not written as nicely as it could be. So we're saying that for the unit, it's 9,000. And for the additional service, the non-lease component of cleaning, it's 1,500. Effectively, I should be paying 10.5 for this. However, lucky me, all in one, I'm paying 10,000 for the same. Now the question is, how much do I allocate to each of those? And the calculation is fairly simple. Most of you have already gone, Kim, we've got this. It's the separate standalone selling price, or it's also called the relative fair value basis. Okay, so it's one guy's fair value over the total of the two's combined fair value, and then we multiply it by our relevant transaction price. And ladies and gents, using that theory for both of the elements, the lease component and the non-lease component, we arrive at the two amounts, and voila, 8571 for the lease component and 1429 for the non-lease component. Effectively, what I'm saying then is that this non-lease component, if you have not chosen to use the practical expedient, this will be an expense in profit or loss, in this case on an annual basis, in your case maybe on a monthly basis. And what I'll do is then I'm going to use 8571 when I'm plotting my cash flows on my timeline. Let's say I've got a 6-year lease or 3-year lease, whatever it is. Okay, so that's the ultimate, is that the combination of all of that at the appropriate discount will end up representing my lease liability, whilst the non-lease component is expense. You can see by separating the components, I'll end up with a smaller lease liability. Not rocket science, a little bit of effort maybe. For a lessor, it's exactly the same concern. Obviously, they're the ones receiving, so they should have a better idea of the selling price of these items, maybe a little bit easier on their side, but it's exactly the same as what we do in IFRS 15. If we're selling more than one thing in a contract, we must make sure that we allocate the selling price to each component. If for whatever reason, as lessee, you do not have a standalone price, a standalone selling price, or a standalone just price if you're the lessee, for some or all of the components, you need to make sure that you utilize where you do have observable information. Let's take a very quick look at that. We've got a 5-year lease that L entered into with M over equipment. Perfect. Contract includes maintenance services provided by M. M also gets its own insurance for the equipment. It's a common situation. The annual payments are, forgive me, simple. I'm trying to, and the currency units have been removed from this page. My apologies. 2,000. So we're going to pay 2,000 for the right to use the equipment over the 5-year lease period on an annual basis. 300 relates to maintenance and 50 to insurance costs. Now, L, as the lessee, is able to determine that a similar maintenance service and insurance cost offered by third parties is represented by 450 respectively. Okay? Now, L is unable to find observable standalone rental for similar equipment. So there's none leased without related maintenance services provided by the lessor. And that's often, ladies and gents, you're also going to find that this is competition-based information. You know, not everyone's going to say, yeah, sure, this is how much I lease it for. They're always going to want to know why. You want to know. Or they're going to hound you forever trying to sell you the same item then. Ultimately, I need to take one step back before I can continue to bring in the other concept. In the third line from the top, you'll see that taxes, insurance on property, and admin costs are addressed. Now, it categorically tells us that if you have activities or costs of the lessor that do not transfer a good or service to the lessee. So if as lessee, you are not getting a specific activity, good or service given to you, but they're recovering the cost for it, ladies and gents, that is not a component. It is simply part of all the identified components. So that will then be allocated on a pro rata basis effectively when you do the allocation concept. So that's what this example is addressing for me. You'll see then that I've said we've got 400 is considered observable. Why? Because I can get similar maintenance services for 400, I'm paying 300. Insurance costs, same, 50-50. And I cannot find a standalone rental for the equipment. So I don't know what my equipment, for which I'm essentially paying this 2,000 broken up into, I don't know how much should be given to the equipment. Therefore, we're going to use the observable standalone price for the maintenance services as 400. Tick. Scribble. There is no standalone price for the lease item for the equipment. And ladies and gents, the insurance cost does not transfer a good or service to the lessee. They aren't paying for that insurance essentially. It's paid by M. M is doing a cost recovery, and I'm not the one insuring it. So it's not my issue. It's not my cost. So I don't split that out. And therefore, because we only have the one item then that needs to be split out, we're going to use, most of you might be saying, Kimmel, isn't this like residual? Yes, it is. In other words, 2,000 minus 400, 1/6 is then allocated to the lease component, assuming you're not using the practical expedient. Okay, so hopefully that puts the majority of those issues to bed. Those are not the main focus, but very important that you understand those can trip you up. And we've got to be able to say what practical experience we have and haven't applied. I have a few minutes before we go for a break, so I am going to continue. Let's see how far we get with a few minutes to go. Single lease accounting model for lessees. It's the only one we're looking at today. Essentially, your lessor has either got a finance or an operating. For us, if we have not chosen the recognition exemption, we're going debit rights of use assets and credit a lease liability, just like we would have under finance leases. Ladies and gents, this is going to result in an additional line item under your assets and an additional, if you've just had operating leases, it will now result in your obligation. There are tax consequences of this, so please don't ignore your deferred taxes. They don't go away. And as mentioned before, we're going to end up with depreciation and interest. That is going to replace what we used to have as an operating lease expense. Now, I'm going to put the elephant in the room. EBITDA, ladies and gents, that earnings used to be a lot smaller because your operating lease expense reduced whatever your earnings were. That is now no longer in there. So in other words, my earnings is going up because the interest and the depreciation is excluded if you are using this as a measure. But it's a measure that is so prevalent. We've seen lots of people finding issues going, oh, I didn't realize this is going to impact this. Well, yeah. And the sooner we communicate, well, maybe we're a little bit after the fact now, but we still need to communicate its impact if it is a measure that we share with our users of the financial statement. I've seen an entity that calculates bonuses using EBITDA. Scary but true. So by no performance change in the employees, they're going to earn more. I think not. I think not. I'm going to stop us right there. This is a seemingly busy slide. It just gets the basics of the lease liability across. So if everybody is happy, I'm happy to give us a stop there. I know we're going to break for 10 minutes, if that's okay. And then we'll see you back in 10 minutes for the rest of the session. We're going to take the rest of the time now to look a little bit more in depth around the transition issue. I stopped here where we started looking at the journal entry. So jumping straight back, both feet, I've already said this is the journal entry. The issue comes about with how do we quantify the lease liability? Because as I've already mentioned, the lease liability is the driver of the lease, of the right of use assets that is being leased. So what we are going to have a look at is a couple of the elements that make up that lease liability. First up, we're going to have lease payments. Secondly, we have a lease term. And thirdly, we have a discount rate. Just to mention, sorry, some side notes, I do have 3 questions. I will address them at the end that Alvin has shared with me during the break. I'll address them at the end. Let's just carry on with where we left off. Lease payments have a very specific definition and what is included in them. One being fixed payments, less any incentives that are given back to the lessee. These include in substance fixed payments. Now, in substance fixed payment is when there is a bare minimum. I do have an example or two, so hang on to your hats. We'll discuss that in a short while. But it basically means that you'll pay us, in substance, we want to have 1 million per month. Anything over and above that is additional. So that there might not seem like it is a fixed payment lease because it has contingency on it, but ultimately if you have to pay a minimum of 1 million, well, that is a fixed payment. So come hell or high water, whatever you produce or don't, they want 1 million a month. Then variable payments. Now variable payments are those that are dependent on an index or a rate. And it also includes the purchase option or any termination penalties. So you'll see here, really just an example. I have obviously increased that final payment. That final payment is either a representation of the purchase option, or if you are planning on terminating early and there's a penalty, that additional could represent the termination penalty. As for the rest of these are your monthly or annual variable payments. Variable by an index or a rate means that I can forecast using that index or that rate. People often say, well, how do I know what CPI is going to be? Well, ladies and gents, you'll use the most recent CPI and extrapolate going forward. That very one, you're going to use it, fixed, whatever it might be now. Goodness, I'm not going to pretend to know. I think the last I looked at CPI was around about 4 and something. So let's just go with 4%. So you're going to use 4% on each of your latest payments, whatever that might be. So it's 4% plus CPI. So that plus 4% going forward. Then you get to next year, and that was now, I'm just going to use a number here of 100. And now your CPI has jumped to 5%. So now you're going to plus it by an additional 5%. And then you extrapolate that going forward. So you use whatever the latest was. And yes, you are going to have changes, therefore, in your lease liability if it is subject to variability based on an index or a rate. Fixed payments, or those that are in substance fixed, will obviously just stay on a flat line unless there is an increase that is stipulated. Some entities have a fixed increase of 7%, 8%. It varies from entity to entity and based on type of asset. Our premises, we normally see an increase. It's roughly been about 8 or 7% with most of the leases that Alvin and I have reviewed. So that's the lease payment aspect. Those are what it incorporates, and that's the picture. I'll get to the lease term last because it is probably the more funky of the lot. Discount rate, well, the standard says please use the implicit rate in the lease. The implicit rate is the rate that exactly discounts all the payments, well, from a lessor's point of view, actually, all the receipts, etc., back to its fair rate of return. Problem is that when we look at it from a lessor's point of view, we take into account any initial direct costs. Now, you as the lessee, you're not going to know what their initial direct costs were and what their fair rate of return is. So it's very seldom also that a lessor is going to share that information with you. So what we see is the standard actually says we expect the incremental borrowing rate to be the most prevalently used. First prize, incremental borrowing rate. Implicit rate in the lease from the lessor's perspective. Can't determine it or can't be given it, please make sure to use the incremental borrowing rate. That is the rate of borrowing from a lessee's point of view for a similar asset, similar period, similar. Ladies and gents, it's also important to note that it's the incremental borrowing rate that is used at transition. So if you are blessed enough to have the implicit rate in the lease, you are not allowed to use it at transition. It must be your incremental borrowing rate. And that must also be disclosed. Every year, we want to know what your, essentially your IBR, your incremental borrowing rate is. The complications that exist there, is it in a group format? Do you have an entity acting as treasury? What will the bank give you a loan at? Pretty hypothetical for most from a discussion point of view, but ultimately, how long is your lease for? How much? And what would the bank lend you the money at now? What rate? That's pretty much what we're after. And one size does not fit all in a group situation, trust me. For a non-cancelable period, we're looking at exactly that. So when we look at the lease term, we're saying, what can I not cancel for under any circumstances? And then we're going to add any renewable periods, and we're going to deduct any termination periods that we are reasonably certain we will exercise. So ladies and gents, in terms of a lease term, our lease term could, let's say, be 5 years with a renewable period of another, in this picture, +4. However, we could also have a 5-year lease that gives us an option to terminate early, no earlier, however, than 3 years. So we will have a 5-year non-cancelable -2, or a 5 + 4. What I've done for you in that regard is I've given you a couple of examples. You just move a couple of slides forward. I'm not going to be reading through these. They are fairly straightforward. The only one I want to address under lease term is number 5. A enters into a 10-year lease. Asset is a plant. The first 7 years are non-cancelable, after which both A, the lessee, and the lessor have the option to terminate the lease. So both have the option. And what we're then saying is that we've discussed it with the lessee A, and they've said they're reasonably certain that they won't terminate early. So the question is now, what is the lease term? And a lot of us are going to say it's 10 years. Well, ladies and gents, unfortunately, as the lessee, you're not the only one that can cancel it. In other words, the early termination is not only in your control. Somebody else can cancel it for you. So in 5, it'll only be 7 years lease term. Very tricky. Our law, our leases in this country, very badly written around renewable options. Yeah, very poor in most cases. So if you do have an option, all you have to do is substantiate whether you believe you are going to renew or not. We've had a lot of discussions, a lot of issues around that. How long is a piece of string? Please note that if you don't have on the table that you're building one of your own, you've investigated options, whatever it might be, we generally look at a 5-year forecast. And if nothing on that 5-year forecast shows me that you're building your own plant or plan on moving premises, I'm not that keen on saying it's not renewable. But we also live in a day and age where things can change pretty quickly. So it's important that we do this at inception correctly, that we evaluate as T's and C's change throughout, and get it right to the best of our abilities. Error always in the back of your head when assessing these issues. So those are the 3 things that go into the value. I've also included an example of an in-substance fixed payment. Ladies and gents, that just says that the minimum payment is 1 million, with my expected usage being 1,500 hours, and 1,500 hours at 1,000 Rand an hour would essentially get me to 1.5 million. How does this work? Well, the lease liability is only going to consist of the 1 million payment per annum for however long the lease is. Whereas every time, if you are to use it for 1,500, so if your expected usage does come to fruition, you're going to have an additional 500,000. And that, ladies and gents, will simply be expensed as and when you achieve it. Okay? So plot on your timeline, your lease liability is going to have payments of 1 million. Let's just call it a 3-year lease. 1 million, 1 million. That's it. Discount those back at the appropriate rate of borrowing, and Bob's your auntie. The additional that you use is then just simply expensed as and when. Why? Because they are variable payments, but they do not depend on an index or a rate. The next two examples also addressing variable. This is a common one that we see in retail. Not often that I've seen it elsewhere, so I'm talking about retail. We want you to pay us 1% of the store's revenue as your lease payment. A lot of entities are moving away from this, so they're going into what we just saw now, a basic plus a contingent, whereas in the past we saw it being purely on, heaven forbid, turnover. So there is no minimum, and therefore, pretty cool, your lease liability at commencement date is 0. And as you go, because you can't project, remember, this is not about projection based on arbitrary numbers. You've got to have something solid in your back. So if we're saying we've got to use store revenues, well, only once those store revenues are earned can we actually assess what we owe. So that'll be an expense on a monthly or whatever the case might be basis. And the last one is addressing the very CPI that I mentioned earlier. So let's say we have an annual rental payment of 2.5 million. Now, if it never changed, it would be, as I explained in the previous example, on the timeline, every cash flow will flow out at 2.5 million. However, if I'm saying that this is CPI based, well then it's got to go up, plus CPI, plus CPI. At the date that I'm going to recognize this thing for the first time, I don't know what CPI is going to be going forward. And in fact, at every reporting date, I'm not going to know what it is going forward. So I'm just going to use the latest that I've got, increasing your payment currently by the CPI for each future period, and then we discount that back. And when we get to the end of period 1 and period 2 and so forth in the lease, we just continue to up by whatever the latest CPI is. We adjust it going forward. And as I said, that results in your lease liability fluctuating. Cool. So those are the variable payments. The facts and circumstances that lead us to how long is the lease term. The standard has given us some really cool examples, and they really are well worth considering. From the assets point of view, what is the nature of it? Where is it? Does that play a factor? I mean, are you going to move? You know, if you're running a manufacturing company, you can't move to a residential area. It's got to be zoned appropriately. Are there suitable alternatives for what you do, maybe in your industry, whatever it might be? And then if you have leasehold improvements, are you likely to move? If you've done a lot of work and you know you're not going to get paid out by the lessor based on your T's and C's in the contract, and you put effort and money into building this thing to look the way you need it to, it's far more likely you're going to renew the lease than put out all of that capital expense again. On the other side, from a contractual or a market perspective, we're saying, well, you need to consider, will the secondary period rates, the rental rates, will they be market or will they be below? Will they perhaps be contingent based? Or perhaps now they're contingent based and you don't really want to rock the boat, or maybe somebody else is offering you contingent as opposed, whatever it might be, your payment structure might change. There might be renewal or purchase options involved that will make you want to exercise, or indeed maybe not. And then there could be costs that relate to the termination of a lease and the signing of a new one. Now remember, if there's costs involved and they are considered substantive, significant, I'm averse to doing this, I'd rather stick to what I know because I don't have another cost layout to incur. And then obviously there might be some costs of returning the asset or breaking it down if we need to return, the earth to what it was, depending on plant, factory, whatever the case might be. So cool indicators, you've got those 5 examples. We've addressed number 5. Journal entries that can follow. So I've got journal entry 1 being the McCoy, debit the asset, credit the liability. Any initial direct costs can be capitalized as well, should be actually, but these need to be very careful. They can't be general, can't be overheads based, must be very specific to entering into the lease. If you had any prepaid lease payments, de-recognize them and then de-recognize the prepayment. So this here is a combined journal entry. You would have had prepaid and bank, and now you're going to go debit the right of use asset and get rid of that prepaid asset. Okay, so it'll be 1 and then 2. And if you do need to have a dismantling provision incorporated, debit the asset and credit the provision. The lease liability, unwind the finance costs and recognize the payment. You cannot choose fair value. It is always going to be at amortized cost. The asset is depreciated. It is also considered for impairment, just like any other asset. The depreciation period, ladies and gents, is obviously going to be the useful life. Oops, don't mean to draw a line through that. Or the shorter of the useful life, or the right of use asset, or the lease term. Okay, so it really is important that we understand what the useful life is to the lessee, and we don't get confused. I'm not going to address the ups or downs. These can be looked at separately. I really need to get to this example. It's important to note here, though, that under certain circumstances, we will revise the discount rate, whilst under other circumstances, the discount rate will remain unchanged. The list is given to us. It's not this easily written in the standard in the paragraphs. This is why you've dialed in today. If we've got a residual value that changes, discount rate stays unchanged. Common sense. Just the payment is just slightly changing. However, what should make sense to you is if the lease term, the length changes. Well, I'm not going to get a loan for 5 years at the same interest rate as what I'm going to get a loan for 10 years, am I? No. So that's why you can clearly see issues around the discount rate. What will that do to my asset and my liability? Well, remember, liability is the driver. If it goes up, it can also go down. The corresponding entry, in most cases, will indeed be your asset. However, in some, it could simply be that you recognize it in profit or loss. Kim, how do I know which one's which? Well, this slide addresses it from the asset point of view. In other words, if we've got changes in the lease liability and they result from lease term assessment, reassessment, a purchase option change, or a change in the guaranteed residual, adjust the right of use asset. That makes sense to me because it relates to the future. If I'm making any changes that relate to past or maybe even the current period only, well, that there is going to be recognized in profit or loss. Similarly, if I'm going to make any adjustments for variable lease payments that do not depend on an index or a rate, they simply go into profit or loss. Please bear in mind, you cannot adjust your right of use asset to be less than 0. So if you have adjusted it and for whatever reason it's come out as, oh, stop at 0, the rest goes into P&L. Okay. Can always be rewritten back up when the lease liability changes. These will be few and far between, I assure you. Presentation-wise, this is just a short summary for you. Have a look at it when you want to, specifically looking at the statement of cash flows. I did mention variable lease payments and short-term and low-value leases payments. Your cash payments for the principal portion of financing, and depending on your policy for your interest, it'll either be in your operating, or alternatively part of your financing. So it'll be an either or based on your choice. Assets, people ask me, Kim, which way should I go? Most people are including their right of use assets with their PPE because the nature of the item they are leasing is very similar to that of PPE. It's unlikely to see on the face that we have a right of use asset note. If the item you are leasing is investment property, it must be included with investment property. That's the point of the asterisk. And lease expenses, we've already explained. The lease liability, interest expense included in finance cost, depreciation based on its nature of what it did, the item that you're renting, and then the short-term and low-value payments as well, included in their separate line items where they fit. What are our key financial ratios that are impacted? Well, it depends on where you're at. If you're not listed, EPS isn't going to be a problem. But understand one thing, it's going down in the first couple of years until such time as we start evening things out. And the reason for that is that the expense we're seeing in terms of depreciation and interest is a lot greater than the operating lease expense was before. Likewise, EBITDA is going to go up. Total assets go up, but net assets go down. Your gearing is horribly increased. And it must be explained because it's awful for a lot of entities. And likewise, your interest cover and your asset turnover will go down. So a lot of things to think about, especially in developing the disclosure that's relevant. Okay, so I'm about to get into the transition aspect. I want to just get a couple of the queries that Alvin has sent me out of the way. So let's go on the first one. First one, someone posed a question around how do we deal with the refundable deposit? Does it form part of the lease payments? Well, I think based on the slide I just gave you of what is a lease payment, the answer is no. You'll treat that no different to how you would treat it currently, i.e. likely part of your trade and other receivables. And depending on the terms and conditions, every contract is different. Some of these contracts will have said that your deposit will earn interest. Some of them don't. It's important that you understand you can't just keep that at the face value if that's not what the contract says. So refundable deposits, yeah, deal with them as you have been dealing them. They are not addressed by IFRS 16. Then someone asked a question around lease improvements. I think, yeah, leasehold improvements. Also not, I know they've got the word lease in them, but they're not IFRS 16. Okay, you are not paying someone else for the leasehold improvement. It is your prerogative if you do enter into any improvements as to whatever your lease contract says, but that you're going to get the benefit of them for the period that you're using the lease, the assets, and subsequent to that, well, if the lessor isn't going to pay you for them, then boo-hoo. So these do not change their stripes. They are still PPE assets. Nothing being right of use here, okay? And then the last one was, what happens if we don't meet, if we don't identify a lease? Well, as I said, it's a service level agreement. So you're basically just getting a service, which is an expense. So just like, you have a monthly telephone bill or, renting a dongle, whatever the case might be, that is it. If it doesn't meet the definition of a lease and you cannot identify either the asset or the economic benefits, or you're not able to direct the use and the lessor holds all the cards, then it's an expense for however long the period is that you're using it. The last one that Alvin just sent through to me a short while ago has a little bit of detail to it, so if you just forgive me. We have a 5-year lease, and both lessee and lessor, it seems, or it's an either or, can cancel with 3 months notice. And history says no one will cancel or has cancelled. What would the term be, and how does, okay, so this is not one that is simple to address, because, and as whoever the delegate is has alluded, we're looking at some history for shizzle. We're saying no one has cancelled in the past. That's lovely. The question, I think, revolves around, and I'm just going to jump back to the relevant slide. What are these facts and circumstances? So how are we going to color in the picture relating to the relevant asset? I'm assuming it might very well be premises. And the question here is, if you're able to get out at any point with 3 months to go, but there's nothing in those facts and circumstances I just showed you, there's nothing that alludes to you are going to cancel. You don't show me any plans. Well, then I'm going that this here is likely that's your non-cancelable period for all intents and purposes. You can't tell me that you're dealing with a 3 month plus 3 months. That's not appropriate. So you've got a 5-year lease. That was the intention and the period for which you are obligated. 3 month period, it's seemingly where we're all going to. It's long enough in this day and age to secure another premises. But I think unless there's indicators at a reporting date that you are planning on exercising this get out, it's a difficult one. I know the question is also being asked in light of the fact that I said that if the lessor can tell you to vamos, that you've got to reduce your lease period. Now, that's a tricky one, because essentially if we were to apply that concept, we'd get to the 0 lease period, which I don't think is effectively making sense here either. On that note, I'm not covering myself in exceptional glory here, I appreciate. The issue that we come across is that, I'm speaking under correction, I think it's paragraph B34. So appendix B34, there's been a lot of back and forth around this lease term. What makes commercial sense versus contractual obligations and the spirit of the standard. So the ISB actually recently came back and said, listen, commercially, we've also got to use some common sense here. This isn't a question of, well, let's write it that there's just a 12-month lease every time and we renew as and when we feel like it. In these cases, even though the lessor has that kick-out right, and we're saying there's no history of ever having done this, we are engaging with them, I just can't see how we wouldn't have a 5-year lease. But this one, whoever asked the question, if that is your real life situation, don't know where your auditors are at this stage, or maybe it is an auditor that's asking it. This one's difficult. This one I definitely engage with. There's more color that I definitely need to this picture. Let's get into the nitty gritty. How do I choose? What are the options? What are we doing, Kim? I need to know, what are the numbers going to be? Effectively, IFRS 16 tells me that we have 2 transition approaches. However, those 2 transition approaches being the full retrospective and inversely the modified retrospective. The modified then breaks it down. It has a further 2 of its own. And it discusses how you're going to do the right of use assets. Okay, so modified retrospective addresses 2 different ways of dealing with the right of use asset. Option one is that we're going to recognize the right of use asset as if IFRS 16 has always applied to it. Okay, we'll do the lease liability separate. We're then going to do the right of use asset on its own. The discount rate, however, that we're going to use there is going to be the rate at date of initial application. Please note DIA is date of initial application. So we're not going to go and use the discount rate that was applicable at commencement date. Commencement date being the start of the lease. That we will use here. So for full retrospective, we need to use the commencement date discount rate. For option 2, ladies and gents, under modified, the right of use asset will simply equal the lease liability. And the only thing is now is that under this option, I have that operating lease asset or liability, you know, the smoothing or the straight lining asset or liability. That guy's still alive. If I've done either of these two options here, let me be specific about option 1. If I've done either of those two, I don't have the operating lease asset and liability. It has been reversed as a result of writing back all of the information. Okay, so I wipe the slate clean before I apply the full retrospective or option 1 under modified. But under option 2, I'm going to do a straightforward asset equals liability. And, what am I going to do with this leftover from the previous standard? Well, you're going to get rid of it. And the standard says you're going to get rid of it to the right of use asset. Don't worry, there's journal entries. I'll show you in a second. And then the big tricksy is identifying which of the practical expedients I want to apply. The little talk box, ladies and gents, to modified says to me that no restatement of comparatives is required. So in your accounting policies, as well as in your either your change in accounting policy note or, I said earlier, the standard and interpretation newly effective note. In that one, I'm going to explain that my comparatives are under IAS 17 and they are not comparable. And I will also have 2 separate accounting policies, one for the current period being IFRS 16 and one for the prior period being IAS 17, just so that the user understands that they're dealing with two different animals here. From next year, different story. Get rid of the old IAS 17 stuff. Now everybody's on the same page. Okay, so the decisions need to be made in a fair amount of a hurry. I try to give it on a step-by-step basis, incorporating everything that we have discussed this afternoon. First question, should we reassess all lease contracts existing prior to the application of IFRS 16? And the reason for this is that IFRS 16 gave us an option to grandfather the old definition. You saw earlier, I discussed what is a lease. Do I have one? And that is quite different to how we discussed it under old standards. So I might very well go and reassess an old lease and go, not a lease anymore. Doesn't fit the definition. The standard is saying you don't have to do that. That could take you a couple of Sundays. So don't worry about it. Close your eyes, grandfather IAS 17's definitioned leases, and move on. Finish them up, transition them, finish them up under IFRS 16, and don't do that again. Under the new lease, any new leases then that you enter into will be under IFRS 16. This is cool. It's an important practical expedient, one that we need to address when we transition. It's considered to give a lot of relief, lots of people going for it. But obviously you can understand that it does bring down the comparability. Okay, so for any leases that are grandfathered, if they would have been different, you're essentially accounting for something a little bit, weird. But be that as it may, we've got that as an option. That's the first choice. Decision we need to make. Second one, are we going to apply any of the recognition exemptions? We mentioned those earlier. Short term, 12 months or less, no purchase option, remember? And then your low value item leases, those that are USD 5,000 or less. If you've chosen them, you won't account for an asset and liability, okay? Also bear in mind that each of these have different choosing mechanisms. If you choose short term for your equipment, then every equipment that is a 12-month or less lease is then short term. Okay, so that is for all class of assets under that. However, the low value is lease by lease. I did see someone did ask that at an earlier point, saying, can I choose to go the full liability and asset route? Yes. You don't have to do the low value with its straight lining. Thirdly, consider the use of practical expedients for the, the previous operating leases. What do I mean by this? Well, here are the operating lease expedients that we've been given. You can choose however many of these you want on a lease by lease basis. So operating lease 1, you're going to go through this list and say yes, no, yes, no. The next one, yes, no, yes, no. What are they? Fairly simple. Apply a single discount rate to a portfolio with similar characteristics. Pretty much what I mentioned earlier on. It's just a huge relief if you do have a lot of leases similar. Just assess if your leases are onerous under IAS 37. Leave it like that. Okay, so just go with the onerous lease. Don't start playing with bringing it on balance sheet now as this kind of lease, and then I've got, how am I going to recognize the asset? I've got to impair that. The standard says just keep them with your onerous if that is applicable to you. Onerous lease, remember, the cost outweighs the benefit. The third one is any lease, ladies and gents, that will be ending within 12 months of the date of initial application. Do it as a short-term lease and walk away. Don't bring it on balance sheet and do the depreciation and just keep it as a short-term. It's much easier. Yeah, lots of people are going for this. It's a very popular practical expedient to apply. Fourth one, exclude any initial direct costs from measuring your right of use asset at date of initial. So you don't have to go and capitalize it and figure out what it was, and no, don't work back, leave it as it is. And the last one, I didn't think I'd ever see the word hindsight in a standard, but it says use hindsight to determine the lease term if you've got options to extend or terminate, which is important. I mean, obviously at date of initial application, we've got to determine how much longer is this lease term still applicable. So essentially you're drawing a line in the sand at the date of initial application to say, will I or won't I exercise any options that are relevant? You could be in your final year of a 3-year lease, but you have a renewal period of another 3 years. Well, if you haven't got another building on standby, trust me, you are going to renew. So our lease would then be your new 3-year period plus whatever the period is that's left of your initial. That then becomes your lease term. Use the discount rate, use the lease payment, and you've got your lease liability to bring on balance sheet. Okay, so that is, in terms of my step-by-step, that's your third option. And now the fourth is, do we go full or do we go modified, and how do we do it? You can see if we're going full retrospective, I did already mention we must use the discount rate at commencement date. If we're using the modified approach, we're using a discount rate at date of initial application. Different. What does this mean? Full retrospective definitely provides super comparability. And there's a lot to be said for it. You know, if you can compare something from day one, well, for the purist, it cleans everything up. However, the costs are significant and it could very much outweigh the benefits of pulling off a full retrospective application. It's also very impractical. I hate the word impracticable. It is a word in terms of IFRS speak, but we'll work with English. It's impracticable if the company has or a group has thousands and thousands of leases. You can appreciate that ain't gonna fly because you've got to go and dig up all the archives, work through it, going backwards. It's tough. So if you're going to do it all as what we're calling a big bang at the date of initial application, your cost is definitely reduced, but your comparability will be low, in fact non-existent perhaps, for quite some time. I'm a big fan of actually saying for how long, but I don't see many entities doing it. You know, I want to know how many of your leases are still using a funky, modified retrospective approach. How many of them are still working through the system? If you've got a lease that's got 50 years on it, I'm never going to be able to compare your financials to someone that's finally cleaned out, the old IAS 17 stuff. But here's the example. I know we only have 10 minutes left. Luckily, it's the last thing on the agenda. I haven't seen anything else coming through from Alvin. So if you do have any questions on transition, pop them through, I'll work them at the same time. This is a lease under IFRS 17. Our inception date was January 2017. It was for 5 years. And for ease of reference, I've kept it at annual payments of 100,000 each. They are at the end of each year. The economic life of the item, the machine, is 10 years. It'll be returned to the lessor after the lease term. Hence, it was an operating lease. The effective date, mandatory in this case, was obviously 1 January 2019 in transitioning. I've given both discount rates, i.e. at inception or commencement, it was 3%, and at date of initial application, we went to 2.5%. For purposes of the example, I have assumed no initial direct costs. However, they would have increased the right of use asset at commencement date if we went either full or we took option 1. What have I done? I've said, let's work out my lease liability using the 3%. Okay, so essentially I'm trying to work out the full retrospective. Work with me. At commencement date of the lease, I had a 3% discount rate, and therefore this is what it would have looked like. I've used a basic amortization schedule. Lease payments, 100,000 per annum. Interest rate of 3%, discounted back, and voila. Okay, so if you're not quite sure how that's worked, I'm quite sure everyone's comfy with it. But I've basically just worked out the finance costs on a per annum basis. My lease liability under the full retrospective approach at 1 January 2019, when I'm transitioning, is therefore 282,861. So if I were to go and redo, for instance, 2017, which is not what you're being asked to do, by the way, but if I was to open it up, I would have recognized a lease liability on day 1 of 457,971. And at the end of that year, I would have had 371,710. And at the end of the second year, i.e. beginning of 2019, I've got 282,861 as my lease liability going forward. Unwinding the remainder of the interest over those last 3 periods, and you've got the gist. Okay, good. What we then need to consider is, what do I do if I'm going to use the modified retrospective approach? Because Kim, you said we have to change the discount rate. For sure. 2.5%. Therefore, my lease liability calculated at date of initial application, in other words, I'm getting rid of the older stuff. I've got 3 years left at 100,000 each, using a discount rate of 2.5%, and I'm working out at a 285,602 for the lease liability. So as it stands already, going full retrospective, I've got 282. Going modified, I've got 285. Might not be a big difference in the example, but if you change the numbers, it can get out of hand. Please note the lease liability is only greater because of the decreased discount rate. The lease liability would be less if my discount rate was obviously higher at commencement date. So this little guy here plays a very big role. So I've got my 2 lease liabilities, but now I'm stuck because I've got the lease liability under full, I've got the lease liability under modified. Now where do I go with the right of use? Remember, I said to you, under modified retrospective, I have 2 options. They are on a choice of a lease by lease basis. Option 1, do it as if IFRS 616 always applied. Yeah, but Kim, isn't this going to result in a difference between my asset and my liability? Bingo. And on the second one, I'm saying to you, the right of use asset equals your lease liability. Dunsky, 285,602. We just calculated that. Now, we would then adjust the right of use asset for any operating asset liability that's been brought forward, but it's 0 in this example. Why, Kim? Well, quite simply because there was no change in my lease payments per annum. If those lease payments went up by a percentage of 8% or whatever, you would have had to straight line them. And that straight line would have resulted in an operating lease asset or liability at transition. The standard says get rid of it into the right of use. So we got to take a step back and go and do option 1 now. So let's calculate. Using the discount rate at date of initial application. This is where the funky comes in. Because 2.5% was not the discount rate that existed at 2017. But we are going to use it as if it was there at 2017. It's reliable. It's what I can determine now. So, therefore, I would have gone back, done the whole shebang again. I've got these payments, boom, 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 at a discount rate of 2.5%. And I work it out at, ding, 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 464,583 at 1 January 2017. Hopefully you can all see that. Okay, Kim, what are we busy with doing here? I'm trying to work out the value of the right of use assets on 1 Jan 2019. Yes. But I'm doing it as if IFRS 16 rules have always applied to the assets. And in so doing, I'm also going to use a different discount rate because I actually can't go back all that way for the asset. I can do it for the liability. Using what I've got, I've then got a value of, that would have been the opening balance at the very beginning of my asset. It's been depreciated for 2 years out of 5 so far. And that gives me, ladies and gents, a carrying value on the 1st of January 2019 of 278,750. So that there is the depreciated right of use under a 2.5% discount rate. Whereas your option 2 is the right of use equal to the lease liability using that discount rate applicable at date of initial application. Okay, so difference, definitely. And you can go and utilize these and just, plug and play your numbers. Is it easy? Not at the beginning, but I've definitely broken it down so that it is a step-by-step approach. What I've then done for you is just to illustrate the different journal entries. If we go full retrospective, there's an impact on retained earnings. Why? Well, because your lease liability was 282,861. Let's just take a step back quickly. 282,861. Your assets, on the other hand, is, your asset is going to be, apologies, I didn't do that calculation nicely, is going to be 457,971 divided by 5 multiplied by 3 years, because that's what you've still got left in the bag. Okay, so just to confirm, 457,971 divided by 5 times by 3, 274,780 rounding 3. Okay? Difference is retained earnings, lump it all and move on. Modified retrospective option 1, this is if IFRS 16 had always applied to your asset. Lease liability was 285, the right of use asset is different, 278, and the difference is 6852. And ladies and gents, in this example only, purely because I didn't have a right of use, an operating lease asset or liability brought forward, it equals the same. So lease liability drives the value. But I have included the journal here to say if we did have one, and let's assume that it was a brought forward operating lease asset, I'm going to reduce that asset and I'm going to add it to the right of use asset. In a lot of the instances that Alvin and I have dealt with, it's actually been a liability, and as a result, it has reduced that right of use asset on day one. It does not affect retained earnings under any circumstances if we are taking modified retrospective option 2. Please. People are writing off that operating lease asset or liability to retained earnings. No. You're mixing the different options then. Okay, so that was my main objective, was to make clear how this impacts what happens with the numbers using as simple an example as possible. Please make sure that when you do transition, that you also consider whether your right of use asset is still in the shape and condition to get the relevant value out of it, as opposed to needing some impairment. We can help you with a simulation. Alvin's the smarty pants in the outfit. He generally writes up our goodies for us that we can do this. I know that there are other service providers out there. People have asked me around, oh, can we capitalize the VAT? No. Okay, no, this is not a finance lease in terms of the confines of a installment sale, or where you're getting an invoice up front. Let's not be daft. We can't capitalize that and have that impacting on these journal entries. It's unless you've got some ruling from SARS, which I'd love for you to share with us. How about no? If you've got anything, we can help you. We look at the lease contract. We provide you with a spreadsheet with all the information, with all the journal entries. And barring any changes in the future, you should literally be able to copy and paste. So feel free to contact either of us. We will help where and when we can. Sometimes it's a bit of a pressure thing, and maybe you just want us to do one and you can extrapolate the others. Let us know. Alvin and I will help as and how we can. I did find some really cool publications. You might want to enlarge this once we make the slides available. The reason I've asked, yes, they are available, and that will be shared with you in a link, so don't stress. Yeah, variety of publications. They are constantly giving us more and more and more information as we evolve. There are some really funky things happening, especially around that lease term. It's interesting. So I've just extrapolated some of the bigger ones. You'll notice that both on the right are from PwC. PwC offer smaller little pages called In Brief. It's really helpful, so worth a search if you're looking for something specific. Thank you. It's a lot. Yeah, you have my sympathies. It's a lot. I can get very excited. I can take you through until much later tonight, but I think let's call it a day. If you do have any questions, you've got our deets. We appreciate the opportunity again to have been able to do this. So thank you to Earl and his team, Clarissa for managing this one, Alvin for not coming to my house today and having me cough all over you. I want everyone to just be as safe as they possibly can. We've all been told how to do this, but there's a lot happening in the IFRS space. Have a look at the going concern issues. There's a lot of publications being shared with us at the moment around what COVID-19 is doing in financial accounting, believe it or not, in impairments, going concern. Have you actually considered the provisions, the impact, all of that jazz? Feel free to give us a shout if you need anything. Other than that, thank you so much for your time. Alvin, thank you again. And Clarissa, thanks for managing.
Cool. Thanks, Kim. Goodbye, everybody.
Thanks so much, Alvin and Kim. Thank you for all the information and for your time this afternoon.
Excellent. Everyone, you be safe out there. Take care, and we will be with you in the fullness. Cheers.